So, Rick Rieder, do I need to move away from technology? Is that the biggest risk space in the market if rates continue to go up?
So I would say no way. I would say there are parts of technology, and we've rotated. I think others have rotated where you own technology. Listen, the semiconductor space, AI, cloud-oriented data assimilation. Boy, there is. I mean, I literally just got off a call going through another extraordinarily newly developing technology that is going to change how commerce works in another way. So no, I'm not worried about it. By the way, you take companies that are growing that have got 20% growth rates and say, gosh, I'm going to rotate in stuff that's not growing, but it's underperformed thus far. As a long-term, as Tiffany says, a long-term investor, good luck with that. I love technology. That being said, we have also kicked out some of these names that when you look at the portfolio, you say, my gosh, what has happened? We should be prudent around some of these multiples on, when you trade at 10 times revenue or higher than that, boy, it's pretty hard to work your way into that multiple, even if you have a 5-year runway.
So let me ask you this, and perhaps then it's way more nuanced than just suggesting that technology as a whole is going to have a problem. But can the Nasdaq and these other technology stocks that are not egregiously overvalued withstand a rush to the exits from the ones that are?
I think so. I think you talk about what we do in our portfolio, and a lot of big investors do in their portfolios. Gosh, you try and take out the places that have become what I would say fluff is in your portfolio in terms of where they stand from a multiple point of view. And yes, you definitely can withstand it. And by the way, I think a lot of places have talked about this. I think you talked about it last time on the show where I said, you guys do some great diligence. We've built a lot of cash in our portfolios. We've eliminated all the interest rate products, the intense interest rate products, treasuries, agency mortgages, some of the investment grade credit, build some cash and take advantage of when the market goes through these points of turbulence to get back into some of these things. Have you been doing that? So yes, unequivally.
Have you been doing that? Because we had that conversation. I think, I don't know, maybe it was 3-4 weeks ago. Yes, we had that very conversation, how your cash level had gone up. And I think you said, I'm trying to remember correctly, I think you said you had taken some profits in the FANGs.
Correct. We have added back some in the, which has been unfulfilling heretofore. We've added back a little bit. We've definitely added, including yesterday, some in the semi space. But I would say net, the bigger adds we've made, and I think Steve said this, or maybe Rob said this, we've added to financials. We've added, we like the cyclicals and we like the consumer space quite a bit. But the ads have been bigger there than in pure technology.
Interesting. Let me get Weiss in.
Can I say?
Yeah, go ahead, Rick. Go ahead, Rick. Then Steve, I want you to get in.
There's this knee-jerk reaction that people have when they say rates go up and real rates go up, and I think if people take time and think about where things like technology are, and you think about where they were and where real rates were, markets like to focus on rate of change. And I think people are misinterpreting how much this moved. It's a big move that happened so quickly. But boy, oh boy, real rates are still negative. There's only been one time in 21 years that they've been negative. I think it was in 2012, 13 for a brief period of time. We're still in pretty incredible times. So anyway, part of why I think perspective makes a difference.
Absolutely.